And they created Recast because they want to see different types of people launching venture firms than the traditional white male coming from wealthy background launching a venture firm. And so because I was selected for Recast Accelerate, I get access to the enablement program. Plus, they're providing 100K in fund expenses or to be used toward fund expenses, and backed by Pivotal Ventures, which is a Melinda Gates company, which is making that all possible.
Welcome back to the Brydge podcast. Today I am here chatting with Amber Illig. She's the GP of the Council and co-lead of the Council Angels. Prior to her investment career, Amber led operations and go-to-market efforts at high-growth startups, including Cruise. Amber and I first met a few months ago when we partnered on an Angel Investing 101 virtual session where she shared an incredible amount of knowledge. And so I'm so excited to have her finally on the show today. So welcome, Amber. It's so good to see you.
Great to see you too. And thank you so much for having me. It's been awesome to partner in the past, so I'm excited for more today.
Amazing. To kick it off, you're the GP of the Council Capital. So first of all, what is the Council and how did you first get involved?
Yeah, it's a great question. So the Council Capital is primarily a venture firm. We focus on pre-seed and seed stage investments in software for hard industries, and we define that as legacy and existential. So if you think about legacy industries, we're talking about things like legacy and existential. We're talking about things like healthcare, logistics, manufacturing, construction, supply chain, transportation. And so things that humans really can't live without anymore in 2023, if they ever were. And things that are many times operationally complex and can be made simpler with software, but haven't gotten the same level of funding or tech talent attracted to them in the past and are now huge white open spaces with massive markets. So that's the venture firm and our whole goal. That said, we actually started as an angel investing community, and that is still an arm of our venture firm and serves as a really powerful arm for deal flow, due diligence, and portfolio founder support. And that's the Council Angels. We now have over 150 members, and it's an all-female group with operators from companies like Square and Slack and Airbnb and Lyft. Everybody has functional expertise, and so founders don't come to the Council Angels just to get women on their cap table, which would be a noble cause. But they're coming because they want that strategic value that every single angel in our community can bring. And so we serve kind of as a matching platform. So the bulk of deals that we do in our angel community are direct deals where those investors can participate directly on the cap table as long as the founder's okay with that. We do occasionally pull together SPVs that pool their investments together if the founder asks us to do that, or if we've previously invested from the council fund and we're opening up our pro rata allocation to the angels.
So to my understanding, it all started with the Angel Group.
It did.
How did you
yes.
first get involved with that? And when did that start? And how did that eventually spin into the venture arm?
Yeah, so the Council Angels started in January of 2019. It was started, between myself and about 9 other women, kind of as a collective with, we had a founder, Annabelle, and I kind of jumped on board in the first meeting, was like, I'm obsessed with this. I'd love to be a part of it. And her and I ended up growing that and scaling it from 10 to 50 members with no website, no marketing in the first couple of years. And we actually didn't intend it to grow at all. It was just because people kept telling their friends about it. But it came together out of personal need. So I personally had been trying to start angel investing. I had just had a liquidity event at Snap. It wasn't like life-changing money, but it was enough to start building a portfolio and a track record. But I had limited deal flow. I didn't know if I was doing due diligence right. I wanted to make sure that I had a community to share deals with. And so there were a few other operators kind of at the same time talking about the same thing, including Annabelle, who was previously the chief people officer at the Assembly, an RIP, amazing spot in San Francisco pre-pandemic. And before that, she was the head of people at Open Door. And then Courtney Lipkin was also very influential in the early days. And at that time, she was a chief of staff at First Round. And kind of taking on her next move as partner at Sousa Ventures. And so, and then we had other members from different companies that all wanted to participate. Like one person was early PayPal, early Salesforce. And we had a few different types of expertise in the group. Like we had some people that have done like 50 to 100 angel deals and others that were just trying to get started. And so we all had something to gain from each other and we would meet monthly. And so I started leading that with Annabelle, and just those monthly pitch meetings, we'd host 2 to 3 founders back to back and then discuss the deals after. And that was really the magic of the council that people kept coming back for, just that kind of community around deal sharing. And the founders would all come and say, like, this is the warmest group of investors I've ever pitched. This is so fun and awesome. So it was really special in the early days. And then we hit the pandemic and went all virtual. And now we're back to a hybrid environment because our members wanted to get back to getting to know each other IRL. But throughout those first 2 to 3 years, I was really helping to grow that community and wanted to launch a venture fund someday. And when it came time to decide, are we doing it as part of the council's brand or is Amber going out on her own? Annabelle was really supportive of me doing it inside of the council. I also felt like the council was my baby at that point, and it didn't feel natural to start over with a whole new thing because I was already spending all my nights and weekends on the council for years at that point. And so it was just natural for this to be the next evolution of it. And at that point, I had like 30 angel investments in my portfolio and had invested ahead of like Y Combinator and Lightspeed and Lux Capital and all these great firms, and also co-invested with many of the great firms. And so I had enough leading indicators that I felt comfortable launching my own fund and raising capital from other people to continue investing in awesome companies, and just wanted to do it within the council ecosystem.
When you made your first angel investment, first of all, can you share what that was? Was that through the early council angel group, or did you source that before and maybe that spun into investing with the group?
Yeah, so my absolute first angel investment was Shoot My Travel, and I invested through Jason Calacanis' syndicate. So I would say the first 3 to 5 deals I did through syndicates because you can write much smaller checks. So I could write a $1,000 check into that company. And it was one of the first few that I saw that looked compelling, and I understood the model because I was working at Cruise and we did a rideshare model, and it was very much like a two-sided marketplace that we were designing to operate like Uber or Lyft. And Shoot My Travel was also like a matching marketplace between photographers in different cities and people that were traveling to those different cities to hire them. And I was really impressed with the founder. She had been bootstrapping for several years and reached meaningful traction. And it was easier for me to get to a yes on that deal because I was really relying on Jason Calacanis and his process in terms of sourcing and doing the due diligence and then preparing a memo so I could actually see how is he thinking about the deal and what are the different things that I should look at in the future if I'm having to do this from scratch. And so that's really how I got started, is through his syndicate, and that really helped me, kind of feel comfortable at some point stepping off on my own to actually source my own deals and do due diligence on those deals.
Well, now myself as a member of the Council Angel Group, that's what I feel like I'm very much getting out of leaders like yourself. So it's amazing to see that you are now providing that to other women who want to learn to angel invest. And to that point, when people are starting to think about maybe dabbling and making their first angel investment, what are some of those like key things that we should be looking for? Maybe walk me through your process of diligencing a deal.
Yeah, definitely. So high level, one piece of advice I would give to anybody that's new is give yourself space between the pitch call and the final decision. I would not commit on the spot if you're meeting with a founder, because one thing I've learned about founders is they're so committed. Each one of them is thinking about their problem 24/7, their problem space, their solution. They are so passionate, and that rubs off on you. And so at the end of when you're talking to a founder that's incredible at fundraising, that is really palpable, and you get really excited about what they're building, and it's easy to get excited in every single thing. And so it's easy to feel like, oh wow, like I have to invest in this company. I would let yourself sleep on it, and then have a process to kind of keep yourself in check, because investing, like, no matter how much people want to deny it one way or the other, it's part intuition, part data. You have to get to conviction, and so you always want to be validating your intuition with data. And that's very tricky at the early stages. So if you're investing at pre-seed or seed, which is typically what angels have access to, a lot of it is about talent recognition and making sure you understand the space, who's operating in the space, where their unique angle is going to be. And so the top 3 things that I look for in terms of talent recognition and just are they the right person to be building this company, is resilience, mission, and vision. So resilience, I want to see that they've been through something in the past professionally that shows that this isn't going to be their first surprise rodeo with many ups and downs and a lot of ambiguity, and having to design things from scratch. I want to see that they have been in a high growth environment and they've helped grow some company, from whether it's from pre-seed to seed or seed to Series A or Series A to Series B. Even growth stage can be crazy for companies, just in terms of the company having to completely change what it looks and operates like on the inside. every single quarter. And so seeing that they've had that experience speaks volumes to me, and it can look different from person to person. And then the mission is really important because I feel like if they don't have a personal mission to the company that they're building, what's to stop them from giving up the second it gets hard? If they're just trying to do this to make money and they were sitting somewhere with a spreadsheet of different industries with opportunities in them, and they said, this is the one where I can make the most money, so I'm going to go launch a startup in this space, that's not that compelling to me. But if they tell me that they had a family member with a particular issue and they're super obsessed with making sure this never happens to anybody ever again, then and they're launching this startup as a result, like I know that they're not going to give up very easily. And then vision is really important to me. So kind of related to the last point, I want to make sure that they see the world a different way with their product in it. And that tells me that they're really wanting to commit like the next 10 years of their career to this problem. They're not trying, again, they're not looking for like a get rich quick scheme or an easy out. Like it's great to have options along the way for acquisition, but I'm really looking for the founders that are building something huge and would be happy taking it all the way through IPO if they have the opportunity to do so. So those are the three things I look for. But then after I've kind of agreed, okay, I love the space, this founder has all those qualities, then I start getting into making sure I've dotted my I's and crossed my T's. And so I have a checklist in the background where I just make sure we've talked about competition and go-to-market strategy and the team and making sure that they have somebody technical that can build all the things they're saying that they're going to be able to build. And so I go through all those, make sure I haven't missed anything. A lot of those things come up naturally on the first call. And then I'll spend a little bit of time behind the scenes just trying to do some extra research and make sure I understand it if it's a new area, or talk to other investors that invest in the space and make sure that I'm aware of most of the competitors that are popping up around them. So yeah, I would just say have a process and stick to it, and that will really help save you from making like sporadic decisions based on intuition alone.
So obviously early stage investing is extremely risky. How have you thought about kind of mitigating that risk and building a good portfolio?
Yeah, so it really does come down to proven operators for me. So kind of that first point around resilience, I'll break it down from a different angle. So what I've noticed as an operator going into VC and kind of reading all the content that's around there about venture, there's a lot of glorification that's given to second-time founders or third-time founders. It's kind of like if you've launched a company in the past and it was successful, you can have an idea on the back of the napkin and you're going to get an incredible term sheet, multiple term sheets at great terms, and you don't even need to fundraise. And if you had a company before and you're a second-time founder, even if it didn't do that well, we know that you've been through the trenches before, and this is not going to be a surprise to you. You're going to do even better on your second company. All of that is true, and those founders are the ultimate operators because they have to wear so many different hats getting their company off the ground, and before they've hired all the different roles they need, that they are kind of like a Swiss Army knife. And so when they launch their second and third company, it makes sense that we put that premium on them. That said, I think that there are 10, 20, 30, sometimes 100 people around that founder at their last company that were very instrumental in getting it off the ground and had to be extremely entrepreneurial in order to even join that company as early as they did. And they've had to see from the inside why they made strategic decisions one way or the other. Many times they've had to build functions out of nothing. Somebody who was maybe the first designer at a company, now they know how to hire designers. They're not just a designer themselves. And they've had to navigate different customer feedback you get when you're building a 0 to 1 product. And so those are the people that I'm looking for. And I think because I invest so early at pre-seed, I feel more comfortable backing founders when I know they've had that sort of experience. So I specifically look for that.
So you've had a ton of years of experience angel investing. So you're now launching the venture arm. Tell us more about the investment thesis and why and how you decided to focus on these spaces.
Yeah. So basically, it all comes down to this. So construction, healthcare, logistics, manufacturing, supply chain, transportation, all of these industries themselves are massive markets. And together they comprise about 50% of the US GDP. And it's actually quite silly that we've spent a lot of time building tech companies for other tech companies and a lot of money doing that as a venture capital industry. And so, and we've seen that in dark times, these are the industries that really sustain. And so regardless of whether you're in a hype cycle and in a bear market or a recession, these are the industries that stick around and they still need a ton of innovation. We have access to healthcare is a major issue. I've done 2 construction tech deals now, and I know that it's tough, even if you're bringing in like $10 to $20 million a year as like a roofing company owner, for example. It's hard to even keep the lights on and know that you're not going to go bankrupt in the next year because you have so many cash flow issues. You owe hourly workers, you're waiting on claims to clear. So there are big existential issues like that in these spaces, and they're a little bit less glamorous to be focused on as a founder or a VC. They just don't get the same level of, I guess, glamour. And so I'm really excited about founders in those spaces because I know they're gritty. I know they have unique insights in those spaces. And kind of why me and why did I get interested in this to begin with? Throughout my career as an operator, I was always interfacing with these spaces. So I started my career at Fortune 500 companies like Eli Lilly and Apple, moved my way down to Snap in terms of company size, went through an IPO there, and then I was at Cruise, and then at Atmos, a construction tech company. And so first half of my career at Eli Lilly and Apple and Snap, I was doing consumer electronics and medical devices. So I was dealing with supply chain, logistics, manufacturing. I was spending like 90 days a year in China, literally walking factory floors. I saw all the inefficiencies that are there. And I realized that we were reverting like 20 years back in terms of the tools that we were using when we interfaced with our partners in these industries. And then the second half of my career at Cruise, I dealt with transportation and I ran a team that was focused on piloting different products in different markets. So delivery with Walmart in Phoenix and then getting ready for rideshare in San Francisco. Learned a lot about garage operations and regulations in cities and a lot more unsexy things. And then finally at Atmos, we were helping people design their homes online and then build them in the real world. So having led operations there, I interfaced with a lot of builders. I saw how their quotes are coming together. I saw, all the mistakes that happen along the way. And so just every single one of these experiences, I was interfacing with one of these industries that we focus on now. And just realized that there are a ton of opportunities there. And so that's how I got excited about it.
What has been the biggest change from moving from working at these high growth startups to now being on the investor side?
Yeah, well, I think a lot of people don't think about this from the outside, but running a VC firm is kind of like running a small business. So it's different than a startup where eventually you're going to hire hundreds of people to be working on your vision. A VC firm may always be very small. It may always be a small team. So having come from companies like Cruise, where I'm in meetings with like 15 people and I'm in meetings back to back every single day, and they're all cross-functional meetings about alignment. Now it's more like, I do a lot of one-on-ones and it's a relationships business. So I'm grabbing coffee with people, whether they're co-investors or founders. I'm on Zoom calls all day, but it's more about getting to know the people one-on-one and what they're building one-on-one. And then even back channeling happens one-on-one. So it's a lot more one-on-one relations in general. And then you really have to wear all hats. So I have to think about everything from like taxes getting filed for the business to content that we're putting on our website and our pitch deck and making sure everything is always aligned and our messaging is always aligned, to actually investing in the companies and building the core product, which is our portfolio for our LPs. So, and then fundraising is a whole nother angle I never had to do as an operator. I was never in a sales role, though I did manage a sales team at one point. And so that part has also been very humbling because it's something I never got the chance to do. And it was always on the other side of the table as an angel investor. So it's very different than operating. I would say the only thing I really miss about operating is, getting to develop talent a little bit more because the teams are so small in venture firms. I have one full-time person on my team right now, one part-time person on my team right now. But I liked being an advocate for, my team of 7 people at Cruise when I was there. And it's just a different vibe when it's so small and you don't have to advocate for people within a larger organization. So yeah. But I get to do advocacy in different ways, I guess, because I brag about our founders all day long.
So you touched on this a little bit, but you brought me to my next point of like, walk us through what it takes to launch a venture fund. Because I think a lot of people don't realize that it's really a startup in itself, to your point.
Oh my gosh, yes. So there's a whole period of time. Like if you're thinking about launching a venture fund, make sure you are being realistic with yourself about the timeline. So there will be a period of time before you even start fundraising and have a pitch deck where you're just trying to figure out who are the right vendors that I want to work with. You need a fund admin, and that's basically somebody like Carta that will provide like an interface for LPs as they invest in your fund. And you can execute capital calls, which means you're sending them requests for wire transfers. Many of them are paying over payments called capital calls. and those happen over time, and you need a system to just run that on. So Carta does that. They like calculate your management fees that you're owed every so often, and do your financial accounting. There are a bunch of these vendors, and I suggest having interviews with as many as you hear of, or as many as you hear good things about, because you want to make sure you pick a really good one, because you don't want them to be riddled with errors, because that's the stuff you do not want to be dealing with. And so there's that, and then there's legal. So there's usually a lawyer that will help you, or a law firm that will help you get the fund off the ground. It's extremely expensive. So I've been quoted anywhere from 30K, which is like bottom of the barrel, like new lawyer, maybe knows very little about venture and trying to get into it, to like 150K just to do fund formation, which is a one-time cost.
Wow.
And that's using like top firms like Cooley and Gunderson and things like that. And that might even be their like friendly emerging manager pricing. I don't even know what it costs for like the big VC firms. And so you want to make sure that you look at all your options. You can get a lot of free advice when you're interviewing different lawyers. So you want to budget time for that. Make sure you get to have one chat with each one. And then you want to have a tax team. So figure out who's going to be filing your taxes every year. You're going to have to submit something called a K-1 to every single LP that invests in your fund. And if your accounting isn't done right with your fund admin, and then your taxes are late, then K-1s are going to be late, which is going to be a bad experience for your LPs. And so all of these things have cascading effects. So you just want to be really thoughtful about them. So that, I would call that whole phase like vendor selection phase. And then at some point you just decide, here's who I'm going with across the board. And there may even be some other vendors, but those are the really critical ones. And you almost, even before having that process, sometimes you want to have like a straw man pitch deck together, because you actually need to pitch these vendors on why they should work with you, because, they're going to make more money working with firms that are raising like $200 million than they are for like a $10 million venture fund or $5 million venture fund. And so you probably have something at the end of the process, but then you need to really refine it. And then the fundraising process is very, very long. So, and it looks different for different people, depending how many connections you have to start and how much money those connections have. And so, there are different strategies. Some of them you can raise a fund publicly, and you just have to confirm that everybody's accredited as they come into the fund, which we can talk about a little bit later. But you make some of those strategic decisions up front, and that determines how you're going to do your fundraise. And even the fund size that you choose determines how you're going to do your fundraise, because it determines which LPs that you should be going after. But I would budget in this market like 18 to 24 months for a fundraise. It can happen in under 12 months, especially for folks that are already connected, or they were like the founder of an incredible startup with an incredible exit. It's going to happen very fast. But for most of us, it's a very long process where you start with your Coast network. They introduce you to people, you go and build out the portfolio. So you have portfolio companies to talk about, and then you come back and you start raising from people you know even less well, and they're excited because there's already a portfolio in motion. And then you finally do a final close where it's like, okay, we're getting close. Now it's all capital has to be in by this date, and we're not going to keep fundraising after this date. So yeah, that's kind of how you, in a nutshell, there's a lot more to it, but that's kind of the process for launching a fund.
That is a lot. Very
It's a lot.
impressive.
Yeah. And I'm like, honestly, I know that sounded long-winded, but that was literally just like the tip of the iceberg.
Oh, I'm sure. Can you share your target fund size or the amount that you raised? And then from there, like, how did that dictate the types of investors that you went after? And then also, is it similar to like the way that startups fundraise, in the sense that you might bring on like a lead investor, and maybe like once you have that lead secured, that might bring in other LPs? Or would love to learn more about that.
Yeah, definitely. So fund size for fund one, I'm targeting 5 million. I can close at 3, and I've already raised 3. Our portfolio construction basically works at both sizes. It's just that at the $5 million fund size, we can write slightly bigger checks within our range into those companies. And so we plan to invest in 30 companies over 3 years with that money. And we've already invested in, I think, 21. So we're getting very close. And so I'm actually planning to do my final close on October 31st, to have a ton of people in the pipeline. And, we'll raise anywhere between 3 to 5 million when it all nets out. But that fund size, basically what I've found is anything under 25 million that you raise, you're kind of shut out from larger family offices and big institutions. Some institutions, like some banks, have been doing smaller fund sizes. But even then, like anything under 10 is hard. And the reason why is that some of them have to pay like 50 to 60K in legal fees just to do one deal. and they want to invest 10% of your fund size and they don't want to go beyond that. And so they can only write a check of like 500K into your fund, but they're spending 50K in legal fees, which isn't a great deal if you're doing a $5 million fund. But if they could write a $5 million check into your next fund, which is much larger, and that's 10% of your next fund, then that's a little bit of a better deal for them. And that LP mentality was really hard for me to understand at the very beginning, because I'm like, $5 million is a ton of money. 500K is a ton of money. But to them, it's very small because they're managing billions of dollars. So each new fund they invest in is a new relationship that needs to be managed. And if they invest in a bunch of small funds, they have to invest in so many and manage so many relationships. And if one of them does really well, even if I had a 10x fund and they grew their 500K to 5 million, that 5 million isn't actually going to make that big of a difference because their whole portfolio is like billions of dollars. So they're constantly thinking like, how can I write the biggest check that makes sense for us in terms of returns versus like, can I just slide my way into this fund, which is, I think, how a lot of angel investors and other types of investors think about things. So yeah, that definitely dictates things. I think over 25 million, you start talking to large family offices, institutions, and then there's even more thresholds above that at 50 million and 100 million, where some LPs just don't feel comfortable under a certain amount because of how much they're trying to return with every single investment.
So much goes into this, as we've talked about. And while you've been building this fund, you joined Recast, the inaugural cohort. Can you share what that is and how that's helped you get this far?
Yes, absolutely. So Recast is an amazing program. So Recast Capital itself has been around for a while. It's run by two LPs, Courtney and Sarah, or previous LPs. So I think one of them worked for a family office, another one worked for a different type of institution. So they're very well networked in the LP space, and they created Recast because they want to see different types of people launching venture firms than the traditional white male coming from wealthy background launching a venture firm. And so they've always had an enablement program where they have new cohorts coming in, and they help them go through like a fund launch boot camp, similar to some of the stuff that I just described, but like literally a whole curriculum about that for several months. And so I'd heard great things about that enablement program over the years. But this new program that they're doing called Recast Accelerate is that plus more. So I now get, because I was selected for Recast Accelerate, I get access to the enablement program. Plus, they're providing 100K in fund expenses, or to be used toward fund expenses, and backed by Pivotal Ventures, which is a Melinda Gates company, which is making that all possible. And they're providing us with professional coaching. So I get 6 sessions with a professional coach, which is something I wouldn't have paid for myself because I'm like bootstrapping this fund and money is so tight. And that 100K, it makes a big difference for a small fund. Like we're a $3 to $5 million fund raising mostly from individuals. And at the end of the day, we don't have a lot to spend on like upgrading our fund admin platform or working with a slightly better lawyer or getting a fractional CFO to make sure that we're doing everything right and take that back office work off of our plates. And with a budget like this, it's not like it's going to get you all the way through the 10-year expenses of a fund on its own, but it can make a meaningful dent in that and help you upgrade a couple of services for your LPs or put some more money toward growth and fundraising. So yeah, it was really awesome. And I've just been really impressed with the network. And the other thing I like about it is that they really kept it merit-based. So each person selected was selected by a committee of 6 different LPs. And those 6 LPs are kind of a cross section of the LP ecosystem. So people from, large family offices, endowments, larger institutions that someday we will need to raise from when we're raising larger funds. So it was cool to know that we were selected by that crew.
Can you explain the math behind a venture fund and why that 100K is so impactful?
Yes. So math behind a venture fund. Wow, there's a lot of math. So there's the portfolio construction, which is how many companies you're going to invest in, and how big of a check you need to write into every single one to make sure that based on the return profile you're targeting with your fund, if 9 out of 10 companies fail and you're investing in 30 total, so you only have like 3 really good winners, those 3 have to be so good that they buy back all of the others. So that's a whole topic in itself. And you want to make sure that the money you're working with within a fund is going to be able to cover that. So you're going to be able to write for me, I'm trying to write 50K to 100K checks into 30 companies. So I have to make sure no matter what, I can still do that so that I can offer LPs the appropriate amount of diversification and be targeting outside returns. Apart from that, so say I raise 500 or 5 million. Um, some portion is going to go toward investing in these companies. And it might be I increase to like 150K or 200K as my check size if we raise the whole five. But there's a whole other list of expenses that you just mentioned that go into running a fund. And some are fund level expenses. So if you're investing in a fund, look at the LP agreement, which is called an LPA, and it will tell you what sort of things qualify as fund expenses. So when I raise the 5 million, there are kind of two buckets that it goes into. One is all that money that's going toward investments, and then the other is the management fee. So if I have a 2% management fee, I honestly didn't even know this before I launched the fund. It's 2% every year. It's not 2% on the amount that you raise. So it's really like 20% of the fund is going toward management fees. So think about 20% of this $5 million would be going toward management fees in a normal environment. Now, that said, I'm like bootstrapping and haven't actually taken any of my management fees yet. But in theory, that's what's happening. And with many larger firms, that's 100% happening. And some of them are even taking more than 2%, like 2.5. And then everything else, and which would mean, 25% of the fund. And so let's just think about it. It's in like 2080. So the 80% is going toward fund investments. And technically you can put things like legal expenses in there too. So even out of that fund expenses, you can pay for certain legal expenses of doing a deal or bringing on an LP, like checking to see if they're accredited, things like that. Might cost like $60 per LP. And then within the management company, there could be other expenses. Like if I want to hire an employee, it has to come from my management company budget. I can't use my fund expenses to pay for that employee. So there's a lot that goes into it. Fund admin is a big one. That can be like 16K a year, or it can be 25K a year. I've seen it even higher than that. It just depends which one you go for and how much of a white glove experience you're getting for you and your LPs. And then there's ongoing legal costs. So even after that fund formation that I told you about, which could be 30K to 150K for just a one-time fee, every year you might need, even if you're being like as careful as possible with expenses, you're probably at least going to spend 5K a year on legal expenses, because there might be some document with an LP that comes up, or with a portfolio company that is converting to a priced round, and you need to have that document reviewed by a lawyer before you sign it. Those sort of things add up. Lawyers are very expensive. And so you want to budget for that every single year. Taxes cost a ton, because these sometimes you need to file in multiple states because you have LPs in different states. You need to provide a K1 for every single one of them. So I know some fund managers that have like 300 K1s because they have 300 LPs. Each one needs to be cross-referenced and done properly. And if there's an issue with one, you're going to need to redo it. And so, yeah, all those things the tax team is definitely going to charge for as well. So yeah, the fund math is, you want to make sure that you're, just being careful and not like overspending on really, really expensive vendors that you can't manage long term, or like bringing on employees when you can't really afford it long term. You have to be thinking about the whole 10 years, because you're only raising money in like the first two. You have to make sure you're leaving enough for all those expenses. And so this 100K from Recast, to tie it back to your question, is really useful, because I could put it towards something that's going toward like growth of my firm and offering a better experience to my LPs, which could be like, upgrading our fund admin to somebody who can respond like this fast if something happens with an LP, versus have login issues and all sorts of other things when onboarding. I could also bring on a fractional COO. I've talked with Strut Consulting. I'm also talking with Andrew Brown from Brownie. I forget what his firm is called, but Brownie something. He used to be at Carta. He's awesome. Both of them are offering fractional services. So he can help with like fund modeling and managing all these vendors. So can Strut Consulting. So instead of me always having to like be the middleman between our tax team, our fund planning team, and our legal team, they will take on the brunt of that work and communicate with all three, so that I can just focus on investing and finding the best companies for our LPs. And so that's huge, because that means I'm spending more time on like the most value add activity for me and my LPs. So yeah, that's how it can be helpful. There are other different ways you could use it, but that's one of the top areas I see folks looking at right now.
Fun math crazy. Thank you for walking us through all of those different layers. And clearly that 100K is incredibly impactful. For other diverse emerging managers who might want to apply to Recast, what advice would you have for the application process?
That's a great question. So I actually don't know if they have a public application up right
Mm.
now, but I would definitely check their website, Recast Capital. I think it might be recastcapital.com. And if they have an email list, I would definitely sign up for that because I know they'll definitely share out when the next applications are open. But that's a group that you should definitely track and maybe even like follow their Twitter account, like kind of follow them on different channels because I think they'll probably just drop the news like, hey, applications are open and due by the state. So yeah, it's a good way to keep in touch with them.
Amazing. I will make sure to include that in the details of this episode. Moving to your content, I love the post that you do about your weekly highs and lows of running a venture firm. Can you share maybe this week or last week's highs and lows and just a little bit about why you share that content?
Yeah, absolutely. So I'll share some highs from this week that haven't yet hit Twitter or LinkedIn. So we just did two deals. It's so funny. It's always like feast or famine, where it's like we'll have 3 weeks where we're like, oh, we're not seeing anything good, and then all of a sudden it's like two hit at once. But yeah, we just made the decision to invest in two new companies. One is focused on manufacturing and helping create automated work instructions from a 3D CAD design. The other is logistics focused, and it's focused on like 3D mapping of warehouse facilities and allowing the people operating those facilities to make decisions based on computer vision versus like a bunch of barcode scanning. So really excited about those two companies. They really hit on our thesis, and I always get excited when I find founders that we want to invest in because it's a reminder of why we're in this business to begin with. And yeah, it just like fuels you for the next, few weeks or months of building in other ways. So that's a huge highlight. And then I would say a low light, I was, really excited to bring on an LP recently. And I was like, they didn't commit yet, but we had a couple of great conversations and they made it clear they were really, really interested in the council fund. And then ultimately they decided that it was too early. So because we're fund one, they really want to see how fund one goes and they want to follow us for a little while and stay up to date on fund updates. And so they were really nice about it. They said, like, we're not just saying this, we really want you to include us on the updates and invite us to your LP summit. And like, we really, really want to get to know you. And so that was nice, but I felt like I had a lot moving, like working in my favor with that one. I had like multiple people like sending them good notes about me that have co-invested with me and founders that have had good experiences with me. And that wasn't enough, but that's okay. I still appreciated the opportunity to get to know them, and I'm starting to keep like a fund two parking lot of people that I can follow up with on the next fund. So added them to my pipeline. But I would say that was a low just because I was excited about it. It didn't work out.
Well, thank you for sharing the highs and lows because I think any entrepreneur and probably like any career professional can like relate to the highs and lows that come with every week. So it's like nice to hear that.
Yes. Yeah. And I see a lot of people kind of bragging about just the highs, and then people kind of keep those like, somebody ghosted them, like they're going to keep that private, but everybody goes through it. And that's my whole purpose in sharing it. So people don't think it's
Yes.
just them.
Yes. Well, you're now encouraging me to share more of my lows, so that will definitely be a goal of mine going forward. And then as we start to wrap things up, can you share a female founder, investor, or leader who inspires you and a little bit about why?
Yes. So I'm really, really obsessed with these two co-founders. So Fifi Cara, and then Layla, her co-founder, from Care. So we just invested in them recently from the Council Fund. They're focused on better maternal health throughout the pregnancy process to ideally like lower the chances of preeclampsia developing around the time of birth. And so this could actually decrease mortality rates of people who are giving birth. And they're partnering with clinicians. I'm just really excited about them because they are kind of the perfect combination of a team. They have a third co-founder who's a CTO, but the two of them just have this awesome combo where one of them is an OB-GYN, and then the other one is like an XYC founder, and this is her second rodeo. And so just really, really excited about that, like that experience that they can pull together to launch this company.
Amazing. Well, thank you for the shout out, and maybe they can be on the show next.
That would be awesome. Highly
And
recommend.
then, amazing. And then finally, where can people find you? Where can people find the council?
Yeah, so I'm Amber Illig on Twitter. It's AMBERILLIG. And then LinkedIn, same thing. You can find me on there. And then if you're a founder and you want to apply to the council, You can go to www.thecouncil.co/pitch-us, or just go to our homepage and there will be like a founder tab with a pitch us tab underneath it, and you can fill out your information there. That said, it does help fast track a little bit if you know somebody that knows us. And so definitely reach out. We have like 150 angels in our network, so we're connected to a lot of people. So just look me up on LinkedIn, see who we have a second connection to with, and that can help. And that doesn't increase your chances of us thinking it's a legitimate deal. It just gets you in front of our faces faster. So we do look at all of our cold outreach, but it just takes a little while to get through it. And I think that's it. So yeah, and if you're interested in joining our angel community, actually, we have our membership application also up on the website. So we'd love to have you.
Amazing. And I'll add, if you are a founder listening to this, I'm part of the angel community, so reach out to me and I would love to meet with you. Amazing. Well, Amber, thank you so much for joining and sharing more of your story. Just excited to continue to watch and be inspired by everything you're doing with the council.
Thank you so much, Rafa, and we'll talk soon.
Thanks for listening to this episode of the Brydge podcast. If you enjoyed our conversation, make sure to like, review, and subscribe. Tune in every Wednesday, wherever you get your podcasts, for candid conversations with the most inspiring female founders and investors in tech.